Are we recording? Okay, good morning. I'm calling the regular meeting of the Board of Investments to order today being Wednesday, July 13th, and it is approximately 9:06 a.m. Before we go forward, I will ask the secretary to do roll call and provide us with some instructions on how the meeting is going to be run.
Thank you, Mr. Santos. This meeting is being conducted as a virtual meeting, so I will do a roll call of the trustees to confirm attendance. Mr. Knox?
Good morning, I'm here.
Thank you. Mr. Green? Mr. Kehoe?
Present.
Thank you. Ms. Greenwood? Ms. Greenwood? Mr. Jones?
Present.
Mrs. Jones?
Good morning, present.
Thank you. Mr. Kelly? Ms.
Yeah,
Sanchez?
Mr. Kelly has been excused from the meeting.
Thank you. Ms. Sanchez? And Chair Santos?
Yes, here. Good morning.
Good morning.
I am here as well. I've finally found the mute button.
Thank you, Ms. Greenwood. Staff participating in the meeting include the following: CIO John Grable, CEO Santos Cramen, Chief Counsel Stephen Rice, DCEO Louis Lugo, Interim Chief Financial Officer Ted Granger, Senior Staff Counsel Christine Roseland, Legislative Affairs Officer Barry Liu. Investment staff include Christopher Wagner, Didier Acevedo, Esmeralda Del Bosque, Ron Sankanwa, Jeff Gia, and Magdalia Armstrong. Consultants are Makita Investment Team, Stepstone Group, and Alborn. Trustees, please use the Zoom chat option to be placed in the queue. At this time, we ask all meeting participants to mute their mic until you're ready to speak. And now we may proceed with the agenda.
Great, thank you. Next item is approval of the minutes for June 13, 2022. I will entertain a motion and also ask for anyone whether or not we have any changes or comments regarding the minutes.
I'll make the motion.
I will second.
Thank you, Mr. Kiva, Mr. Knox. I don't see any requests for any amendments. Oh, Mr. Jones, I believe you.
Yeah, hold on. Let me make sure this is not my bad eyes. We wanted, was that Wednesday, June 13 or June 8?
June 13th.
All right, so then
Well, you know what? Looking at the minutes itself, it says June 18th, but the agenda says, I thought it says 13, 13, yeah. So,
yeah, so that might just be a little typo or correction there. I'm not sure how extremely material, but it said June 8, Wednesday, 9 a.m. So you may just want to get that correct.
Linda?
Yes, we'll make those changes.
All right, so we are dealing with the June 8th meeting, not the 13th.
Correct.
Okay,
So
good.
the minutes of the June 8th.
Okay.
All right, June 8th, the record will be reflected. Any other comments? Hearing none, roll call, please.
Mr. Knox?
Aye.
Mr. Green?
Aye.
Mr. Kehoe?
Aye.
Ms. Greenwood?
Aye.
Mr. Jones?
Aye.
And Chair Santos?
Yes,
Okay, the motion passes unanimously.
thank you. Next item is report on closed session items. Mr. Rice.
Pardon me. Yes, pardon me, Chair Santos. Any report out will be posted on LACERA.com after the meeting. Thank you.
Okay, thank you. Next item is public comment. I have not personally received any requests. Linda?
We have not received any requests from the public to address the board.
Great, thank you. CEO's report.
Yes, thank you, Chair Santos. Good morning, trustees and everyone. Very quick report. Wanted to highlight our recruitment efforts in terms of our investment staff. I know that the Board of Retirement asked us to prepare a more extensive briefing for you, which we will have for you in August. But I do want to let you know that we are in the process of finalizing the Senior Investment Officer exam. We intend on promulgating a list sometime by the end of the week. And then once we have that list, we intend on processing or actually scheduling interviews with the selected candidates beginning on the 18th. And so we're making some movement and progress on the Senior Investment Officer positions. We've also provided our investment team for the other positions, the FA3s and FA2 positions, with the materials that they need in order to make their evaluations and assessments of the candidates. We'll again be providing a more extensive report for you in August. So I did also want to point out that as of last year, we have processed 68 separate HR transactions. So we have promoted 32 staff. We've hired 33 new hirees that we've onboarded. We're in the process of onboarding 3 additional staff in the FASD section, which is important. We had a conversation and continue to have conversations with Mr. Rice about his hiring needs in terms of bringing on an investment counsel as well as a benefits counsel to assist us with the workload as well as our succession planning. So I did also want to mention that that we have been working with the executive office for the upcoming election for our safety member election. And so that election period, I just wanted to make sure that you were aware, it begins August 5th and goes through August 31st. And with that, we'll be more than happy to stand for questions.
Great, thank you, Mr. Kryman. Ms. Jones.
Good morning, Mr. Kryman.
Good morning.
I just had a few questions. One is, I noticed in your pie chart where you show the number of vacancies, it looks like, is it systems that has a very large number? And I'm sure, you share in the concern with all the cybersecurity threats that are out there. And I was just wondering, and trust me, I understand it's really hard to get staff and everybody has, a need, but I do know that that's like a really important area to be fully staffed. So I was just wondering what your thoughts are in that area.
Yes, historically, we have had a large vacancy in the IT area. We actually are in the process of onboarding 3 new IT folks. I know that we have exams out for a couple of other items in order to fill the positions. About a year ago, maybe a year and a half ago, we made the cybersecurity a focus for reconstituting our IT section. So we actually have now, that we didn't have about a year ago, an Office of Information Security.
Okay.
And so right now it's staffed with contractors, consultants, but we intend on bringing an exam forward so that we can attract staff to handle that line of business. But we share in your concerns. We've been doing a lot of reflection on what we need to do, especially since we turned the organization from an on-prem, primarily to remote access. And so we have made some strides. We've changed our configuration. We've created our own LACERA cloud that helps protect us outside on the edges. The real concern that I always have, of course, is the internal human error. Someone clicks on something accidentally or without malice, and those are the things that we're trying to guard against. The 0-day issues are important for us to keep track of. And so we do have a pretty robust IT security unit that assists us with protecting not only our members' data, but all of our systems as well.
Thank you. And then just a comment, I guess, that I wanted to make, and I was really excited to hear when you shared the number of promotions that have occurred. Because I do see from your report, there's a record number of retirements that are going on, and I think that's everywhere. I think those employees that survived COVID have decided they had enough. They're going to retire now.
Yeah.
So I am excited to hear that you guys have some forms of succession planning in place, because it sounds like not only are you hiring new staff, but also there's promotions going on. So that's exciting, to hear. It is right now a very tight market to find staff out there, and other, it's like literally having to pull people from other agencies. I mean, it's getting very difficult. So it's really great to hear that. Along with that, you guys are also able to promote within and give opportunities to current staff.
Great. Well, I appreciate that. Staff, our existing staff are very important. We need to take care of them just as much as trying to recruit the right person. So thank you for your comment.
And I think part of some of the issues that we have with the hiring, at least in some of the key classification, particularly IT, is that the board of supervisors, in my view, unlawfully has refused to implement some of the classifications and paid that it requires in order for us to compete in the industry. So that's another obstacle that we dealing with it, and we do have filed a lawsuit to get that corrected by the board of supervisors. So we had fired at all cylinders. Mr. Jones.
Oh, good morning, Mr. Kryman. Just a couple quick nerdy questions for you here. In the dashboard, I just want to make sure I understood under your key performance indicators, under your striving for excellence components, you mentioned grade of service. And I want to make sure I kind of understood what you mean there, because that's apparently the only bar that you're kind of underperforming on. But is that because the nature of the calls coming in don't lend themselves to 60-second completion, or on page one, that one, and then on page, where's the other one? You see the little area I'm talking about under the striving for excellence, key performance indicator components, call monitoring score, then grade of service?
Yeah, grade of service. I think JJ would be in the best position to answer that particular question.
Thank you very much.
I'm sorry, through the chair, Mr. Santos.
Thank you, Mr. Popovich.
Thank you very much, Trustee and Trustee Jones. The question is, that's our speed of answer, basically. It's supposed to be, we answer 80% of our calls in 60 seconds or less. And so we are currently experiencing some extremely high wait times. And we did a recent report to the Board of Retirement on the reason for that and the steps that we're taking to address that concern. But that's what it refers to.
Gotcha. So it's just the time between when you initiate the call and when you get a live person to respond to it.
Correct.
Okay, super. All right. The second one in Santos for you here, are you noticing any differences yet in the pattern of retirements? I know we have kind of an actuarial plan where we have a distribution of how many, what years we see people retiring and coming on to plan realization. Are you noticing anything different about the pattern at all?
Well, there are some differences. They're not wide swings. They're pretty consistent year over year, unless JJ tells me something happened. But at least the numbers that I've seen, they are rising slightly. But I think the issue is really the call volume. It's the individuals that want to know about their plans. They haven't made the decision, but we have to counsel them and make sure that they have all the information that they need. So there's been an explosion, quite frankly, of the number of calls and number of counseling sessions that are being requested. But the number of retirements has increased slightly. But it hasn't been an overwhelming
Right.
number. But it is all concentrated at the end of the year, the end of March, our March Madness period. So the spikes are pretty high.
Okay, two more questions, if you would, Mr. Chair. Have you seen a difference yet in, I know we've invested a little bit or a significant amount of technology in our customer contact approach from a technology standpoint. Are you seeing more of that incoming calls being shifted off into the technology piece, or are you still seeing the level of high touch, personal requirements that were there, let's say pre-pandemic per se?
We're still tracking the number of the number of personal service that individuals will get online and process their change of address, for example, or but by and large the technology has helped our members to go to our services and require more counseling services, right? So the technology is working in that people are reaching out to us and they're asking us for counseling sessions and to handle some issues, but I don't believe that there's been a demonstrable change in the patterns of behavior of our members. We're just doing it virtually now, right? So, and those calls have extended as a result, because most of the individuals that we're counseling, we'll have a counseling session with them, and then they'll say, well, hold on, let me talk, you need to let my wife know about this, and then they'll bring her on board, and then it just kind of keeps growing and growing. And so as a result, the time spent on the calls have increased significantly as well. And right now our staffing, we have trainees that are not productive at this point in time because they need to be trained on all of the different systems and all of our different plans and so on and so forth. And so that's a 10-month training program. So we're hopeful that once the training, which will be done, I think in October, if I remember correctly.
November.
October, November, we'll see a decline in the call volumes, or at least the wait times, I should say.
All right, thank you, son.
In addition to that, we're also exploring some additional ways to deal with the queue, and so we're working with our provider, AWS, to help us with moving the calls through the system one by one, quite frankly, getting them in the right queues. Because right now we have one queue, everybody calls that particular queue, and then someone has to triage it and then send it to someone, or they handle the call themselves. So,
I wasn't sure if we had reached the operating leverage point in some of our customer service technology use, not, but it's interesting that you're actually creating higher demand through technology for more personal services on the other end. That's okay.
Yeah, that's correct.
If I can add something to that, one of the things that I've noticed over the years is the better job we do of educating members, the more questions they have. And so one of the reasons for the increase in duration is members are doing more what if scenarios. Well, what if I wait, this to this age? What if I, wait a year of extra service? Or what if my, especially when we get into things like negotiating periods between the unions, well, what if we get a percentage increase and things like that? So the members are more educated, and when they're more educated, they ask more questions. And that's, the increase that we've seen. Our highest duration calls are our retirement counseling calls by far. And those are the ones that we've also seen some of the duration in. So there's a pretty steady increase in people that use the basic, account maintenance things, address changes and things like that for technology. But when it gets down to the more, more of the counseling sessions, that's where it really winds up. And so as Mr. Kryman mentioned, we're working on a way to allow people to, hold their place in line while they're waiting to speak to a member so that we can call them back. So we're working with AWS to implement that. And I'll have some more updates on that at the next Board of Retirements meeting.
Okay. Thank you, gentlemen.
Yes, so just a quick follow-up Mr. Popovich. Because of the pandemic, we suspended the program where the staff goes out to usually the largest facility. And I know the rule has been that if you can deliver 10 people to a LACERA meeting at the location, that the staff will come out and make a presentation to the members. So have we compared the participation of our members when we are in the field compared to doing it through Zoom? Is that a good? What is your analysis between those two programs? Do we want to keep them both? Is the electronically enhances that aspect of the education process?
Yeah.
What's your view of that?
So actually, I believe we will keep them both to some extent. Webinars are actually a better approach to it because, as you mentioned in the past, we had limits or minimum number of participations before we would go out to a particular office. And when you go out in the county, and you're entering one of the locations, you're pretty much only serving the members in that location. That's it. So, if I send out somebody to handle 10 members, even though there may be other people, around that campus or around that area that may want to also participate in our pre-retirement seminars, they can't, because you can't usually get into other facilities if you're out of other departments. So one of the huge benefits of having webinars is I can put a webinar out there and I can just have as many people as can log into it. And so that's one of the benefits of having electronic services versus in-person services. So we have not yet sat down and done the participation metrics so that I can put it together and tell you exactly what the difference is. But we will do that. But the feedback I get from staff is there's a lot of response and it's multiple departments at one time, which allows us to serve more people than we used to be able to serve the other way. It also has increased our ability to partner with Empower. We tend to like to try and do pre-retirement seminars where Empower can join in as well. So we did that pre-pandemic, but it was always subject to whether they had somebody available and whether they could go with us to a particular location. Now, we can do that more often through the webinar. So it's just it's increased our ability to partner with them.
Good. Thank you very much for that. Any other questions? Seeing none, we're moving forward to Mr. Grable, CIO report.
Thank you, Mr. Chair. Good morning. Good morning, trustees. I'll give Kwok a moment to pull up the slides and thank Kwok for driving slides today for the board meeting as well as the equity committee meeting. So thank you, Kwok. Today, if my calendar is correct, is our first board meeting of fiscal year 23. Fiscal year 22 was a tough one. So happy new fiscal year to everyone and best wishes for positive actuarial returns, beating our benchmarks, managing our risks, and as we just discussed during the CEO report, for an ever-improving member experience. This morning, I'll cover 4 points. The first being June, the stock and bond markets. May, our portfolio performance. We added a new risk slide that I'll introduce, as well as discuss our currency hedge, which is timely considering some of the questions that were asked during the equity committee. And Kwok, if we could turn to slide 4, please. So the charts, the 4 charts on this page show detailed returns for the month, year, and multi-year periods ending June 30 for major equity and bond markets. The charts are just brutal. And brutal is somewhat of an understatement or term of art or something, but global equity markets as seen through the All Country World Index in the upper left, the ACWI IMI, which is our global equity benchmark, public equity, was down 8.6%, not for the year, but for the month of June. The 1 year is down 16.5%. As we can see on the right, upper right and bottom left, that there were similar drawdowns for the US and emerging markets. What you can see is that there is better relative performance from US markets. The chart on the bottom right, the Barclays Aggregate Bond Index, that's our benchmark for investment grade fixed income. And that was down over 10%, 10.3% for the 1 year period. And talking about negative stock and negative bond markets really is something worth pausing on, because much of our portfolio construction long-term, recognizing that there are variances and anomalies in any given year, any given period, but it's really premised upon low correlation between stocks and bonds. And that low or negative correlation did not work last year. If you look at, the 60-40 portfolio of 60% public equity, 40% bonds, sometimes it's called a reference portfolio or a low-cost beta portfolio, that was down 14% for the 12 months ending June 30. So that just is not what we expect. To see such high correlation for those really are the driving forces for portfolio construction. And maybe that drawdown, that down 14% really is exhibit A for why we need to have a diversified portfolio. So we'll turn to slide 9. Thank you. And this is the second topic, which is our May portfolio performance. And it's covered on this slide and slide 10, but we'll stay on slide 9 for the time being. And May, these are our net results. And May was a surprisingly good month for the trust. If we look at what the public equity markets did in May, they were flat. So the fact that we were up 60 basis points net is a positive. And also, as we'll be able to see in the next slide, we had a good variance against our benchmark. We were positive, we had positive outperformance. And the total fund as of the end of May is $73.2 billion. Our cash balance stood at over $770 million. Which is in line with our target. And we could see on the right, our asset allocation, that everything is on target within the bands around the major asset categories. We have 4 or 5 functional categories, including overlays and hedges. I'll note while I'm mentioning this, that as of July 1, as of a couple of weeks ago, or 10 days ago, we moved to our final targets, the final policy targets from the from the 2021 asset allocation study. So the shifts that we'll see over the next, that will be reflected in our performance beginning in July will include increases to private equity, increases to long-term treasuries, non-core real estate, illiquid credit, infrastructure, and hedge funds. All those will be going up in terms of their targets, and there'll be decreases with respect to global equity, liquid credit, natural resources, and investment grade bonds. And I'll note that this does not require drastic change. And for 2 reasons. One is kind of an unfortunate reason, which is called the denominator effect. The fund had poor performance during the month of June. And so as the denominator gets smaller, potential underweights get closer to target. And Natalie discussed that about private equity in the prior session. And that's not a good reason to get to our private equity target, for example. I'd rather have as big a denominator as possible and have more work to do in terms of hitting private equity or other targets. But the other reason why we are doesn't require drastic changes is that we have ranges around these targets. And as of today, we're within the ranges for all asset categories. If we could turn to the next slide. On this slide, I'll talk about OPEB and the fund as a whole. OPEB AUM was 2.5 billion as of the end of May, down 70 basis points, and very different performance compared to the pension. And that's driven by a different strategic asset allocation as well as implementation. As you may recall, the OPEB trust as of now is virtually all indexed, and that will be changing over time. We're likely next month, we'll have a recommendation for the Board of Investments for an alternatives portfolio. There's an open RFP for that, and we'll likely have a recommendation. Going back to the top of the slide, where it talks about the LACERA pension fund, we headed into June with 3.9% positive performance for the fiscal year. Our books for the fiscal year, our performance book and our accounting book have not yet closed. I do have access to flash reports. They're precisely that, flash reports. It's showing that we may be marginally positive for the fiscal year. Once again, June was a very tough month. The first half of the year was a very tough environment to be investing. I certainly do not celebrate coming in below 7%. That is our median expected return for actuarial purposes. But I do recognize, and it's important for us to all note that over the past year and beyond, that we've all worked hard and smart to be close to flat, maybe slightly negative, maybe slightly positive. I'm not sure what the number is, but that's compared to a reference portfolio that's down 14%. That's also compared to our benchmark that, may be down, mid-single digits. And there's some contributing factors, I believe, as to why we're performing well compared to our reference portfolio as well as our custom benchmark. The first is, and this comes from the Grable's greatest hits. It's a broken record. Maybe there's one greatest hit on it. There's no B-side. It's asset allocation is the first and maybe only hit. Our portfolio has multiple notes. It's not just public equity. We embrace risk management through the functional framework that the Board of Investments adopted in 2018. So for example, we may have underweights and overweights within a functional category. We're overweight, for example, private equity, we're underweight global equity, but we're net neutral at the functional level, which allows us to stay true to our strategic asset allocation. I'll cite, even though I said I only have one greatest hit, I'll try to come up with a couple others. The second reason is implementation. I think it's too easy for us to say, we have great manager selection. I would rather give credit to all of us for our active portfolio design made through our structure reviews. In those structure reviews, we discuss things such as active versus passive versus factor strategies. We discuss and shape guidelines around stage, sector, and geography. And this is across different asset categories. We balance portfolio implementation between established firms, specialist firms, and emerging ones. We make allocations, decisions high level between direct fund investments, co-investments, and secondaries. I think that really plays a huge portion or is a huge driver beyond manager selection. I think manager selection really is subordinate to that implementation level decision. And then the third area that we may not spend enough time focused on is operations. I'll talk to this in a couple of slides, is currency. Currency played a huge role for us over the last year. Our cash overlay program, which I talk about as it reduces our active risk, but is fundamentally systematic rebalancing. And then some other decisions that we make collectively about the use of separate accounts, lower fee structures. We discussed that last month, such as dedicated managed accounts and hard fee hurdles. I think that asset allocation, implementation, and operations are things that we should all be proud of. It's our efforts, and it's not sufficient to say that managers are good. I think that's a throwaway in some sense. I prefer to say that we're good. And it's these reasons, once again, asset allocation, implementation, and operations for our relatively strong performance. Once again, we're not going to be at 7%, but our performance will be relatively good and better than our benchmark, and that's because of us. And that may be, I hope it is, hope's not a strategy, but I hope it is why we may be marginally positive. I hope we are for the fiscal year. If we could turn to slide 11, please. This is a new slide. We talk a lot about risk and return, and the premise behind that is we should be adequately compensated for the risks that we take. Absent such compensation, we should always choose the less risky investment. And the example of this is, and this is, if with two Fs, if and only if public equity outperforms private equity over long-term, we should then choose public equity because it would potentially be lower actual volatility, more diversified, greater liquidity, lower fee, and less leverage. But that's risk compensation. That's what we saw in the prior session, that we are being compensated for those risks. So what this slide compares is our active return with our tracking error. And tracking error can also be called active risk. This is for a 36-month rolling period, such that we have more data points. And active return, I'll define active return, active risk. Active return measures our performance of the portfolio compared to the benchmark. And tracking error, which is the dark blue line, that measures the volatility of returns between the portfolio and the benchmark. So active return compared to active risk. And in this chart, we try to show that we are being compensated for our active risk. We can see that our tracking error, the dark blue line, is increasing steadily, but not dramatically. And that one would expect as we're increasing our allocation to illiquid investments such as private equity and illiquid credit. Against this measure, we see our active return, which is beneath that, is increasing smartly. It's going from negative to positive. And I think some of the reasons for that I mentioned in the prior slide are implementation and operations. And maybe the takeaway from this slide is that we're always trying to improve our metrics and improve our discussion, but that we're better implementing the portfolio, all of us, and we're being compensated for the risks that we take. That is absolutely critical. It's critical in a low expected return environment. This is absolutely essential. And but with that said, we should focus on the trend, and this is not an end state for us. We should always focus on improving that which we do. And the last slide I'll talk about is slide 18. Okay, now that we're slide 18. During the equity committee, there were some questions about the strong US dollar. Here, if you could look at the chart on the bottom left, and that talks about our currency hedge. And if you were to look at this table in the 1 year ago period, May of 2021, the inception to date gain for our currency hedge was $835 million. At the end of May 2022, the inception to date gain is $1.1 billion. So the quick math is about $250 million gain over that 12-month period. As a reminder, LACERA employs a passive currency hedge for our global equity portfolio. We hedge 50% of our the major currencies in that. It's a passive hedge. Over the 12-month period, that hedge gained 5.9%. That's a huge move. Calendar year to date, the US dollar has appreciated 12 to 13% against a currency basket. And that this gain that we show, that $250 million, is despite reducing the size of our allocation to global equity. So once again, this is the point about operations and how we choose to implement our portfolio and the programs and the structures we put in place. They are making the difference in what has been a very challenging investment environment for us. And with that, Mr. Chair, I'm happy to pause for comments or questions.
Thank you very much, Mr. Grable. I don't see any request to speak. Ms. Jones.
Good morning, Mr. Grable. Thank you for the presentation. And you already answered, one of my main questions, of course, was, as we go into this next year, and if we do enter into a recession, what measures are in place to help us do it as good as we can given the circumstances. And you gave us gave me, great answers with the, what were they, the Grable, I should wrote that down. The Grable laws, was it? And so I appreciate that information, and I was very impressed with the return, fiscal year to date return, although, as you said, it's lower than the 7% discount rate. In this market, that return is just phenomenal. So very excited. Also, I just wanted to say, I do look forward to getting the recommendation from staff for the OPEB. I'm glad that that's something that's being addressed, because, I did notice the last few reports, it seems like that whole investment pool there is struggling. So I look forward to getting the recommendations for staff to take a look at that at a, deeper level. Other than that, thank you for the report. And it was very informative, and it's good news, in my opinion, where we stand so far this fiscal year. So thank you.
Any comment, Mr. Grable, on that?
I appreciate the comments. Thank you.
All right, appreciate it. I got a quick question just to follow up on Ms. Jones. So the Board of Investors made the decision to begin investing in private equity for the OPEB. Where are we in terms of the implementation? Where are we with that strategy?
Mr. Chair, we're likely to make a recommendation next month. The RFP was to create a separate account to help begin the implementation for all illiquid categories, be it private equity, real estate, illiquid credit, and the RFP is underway, and the recommendation will likely be next month.
Very good. Thank you very much. Any other questions? Comments? Hearing none, we're moving forward. Okay, next item is consent items. Item 7, subsection A, B, C. I would entertain a motion to approve all of them unless there's an objection or one of my colleagues would like to discuss a particular item on the list. Hearing none, I will entertain a motion to approve items A, B, and C.
This is David. I'll move to approve them. Second.
It's been moved on second. Roll call, please.
Mr. Knox,
Aye.
Mr. Green,
Aye.
Mr. Kehoe,
Aye.
Ms. Greenwood, Mr. Jones,
Aye.
Mrs. Jones,
Aye.
and Chair Santos.
Yes.
Okay, the motion passes unanimously.
Great, thank you. Moving to section 8, non-consent items, subsection 8. Ms. Del Bosque.
Hi, good morning, Chair Santos and trustees. Wanted to give you some context around the presentation that the team will be delivering, and start off by saying that in August of 2018, the board requested staff to conduct a feasibility study on internal asset management for public markets. And since then, a series of presentations and reports have been given to the board. Now, as a reminder, the initial board report provided by Net Alpha, LACERA's internal management consultant, included baseline preliminary costs for an internal trading program, and those cost estimates were intended as a foundation to be built upon. Now, given all that has changed in the world, and as a result of the work from home experience, a considerable thought has been given to prioritizing the adoption of internal management at this time. A group of investment staff, including global equity, fixed income, real assets, reviewed and updated the net alpha analysis, which we'll share with you today. At a high level, we observed that for LACERA to be successful in this endeavor and have a platform which functions 5 nines or 99.999% of the time, we want to focus on an infrastructure build out that is both financially and operationally sound. And in order to do that, we understand that this will be a true multi-division LACERA effort. An example of that is that we'll have to rely on systems and information technology for data infrastructure and cybersecurity management, as well as human resources for personnel, which we will cover in today's presentation. It's divided in 3 parts. We have Migdalia, Ron, and Jeff to review the presentation with you. And we're going to cover what's been accomplished to date, provide an updated, a revised cost estimate that includes that operational framework and personnel that I alluded to earlier, and provides a holistic assessment of the considerations, the risks, and impacts that internal management may have on LACERA. Now, Makita supports staff analysis and recommendation to pause the project at this time and reassess after the next strategic asset allocation. Their concurrent memo and commentary is in attachment B of your packet. With that, I will turn it over to Migdalia to launch into the presentation.
Thank you, Esme, for kicking us off, and thank you, Kwok, for driving the slides. So let's go ahead and jump to, yes, thank you. So as Esme mentioned, the objective of today is to continue the discussion of the internal management project and review the findings of where we picked up from the last analysis. And what you've read and what you will hear shortly is that our findings point to greater economic benefits for external management. And as mentioned in the opening remarks, we recommend to the board that the project be reassessed until after the next strategic asset allocation. Next slide, please. This slide touches on the project team. And while this analysis focused on global public equities, it also did touch on other public markets, and therefore you see the team members from the different asset classes. Next slide, please. So these next 2 slides provide the timeline of the project, and I'll highlight some of these events. And starting on this slide, the project was started in August of 2018, where the board asked staff to analyze the pros and cons of internal management. And at the 2019 offsite, there were guest speakers from peer plans to share their experience. And the takeaway, one of the main takeaways is that a must-have for a strong program is to have solid compliance and operations in place. And we'll touch on those needs in a short moment. Next slide, please. And following in the year 2020, preliminary results were provided to the board. Net Alpha was hired to do the independent study. And in their report, they proposed to introduce internal management in phases and to do passive US equities as a logical first step. And also in that first pass of the analysis, costs mainly focused on data and software. And then continuing on at the 2021 board offsite, the board was surveyed and indicated continued interest in this project and also expressed concerns, namely cybersecurity and operational risk. This concludes my remarks, and I'll hand it over to Ron to discuss the estimated cost breakdown.
Thanks, Migdalia. Slide 7, please. Thank you. The consultant initial report focused on the infrastructure build for U.S. passive equity assets. Their preliminary cost estimate included a minimally viable setup to run internal management, such as index constituent data and basic technology needs. Obviously, a lot has changed since the initial report. We went through a COVID lockdown and had to factor in resources needed for a remote hybrid working environment. We also included expenses such as LACERA personnel needed from other divisions, a robust order management system, data subscriptions, and risk and performance attribution modules. We'll cover the cost analysis in detail in the next slide. Next slide, please. Yeah. There's a lot of information to process on this page, but we wanted to provide you with as much information as possible. I will walk you through the table in detail and provide you the key takeaways at the end. Focusing on the top half of the table in blue, the stage or asset class column starts off with the simplest asset class, specifically passive US equities. We then move on to more advanced stages of internal management, such as factors and non-US equities. The consultant did not conduct analysis for tips and cash. The initial analysis on the left-hand side of the table shows preliminary estimate by the consultant. The columns show investment management fees paid, estimate of cost to internalize assets, and the resulting estimated savings. The current analysis on the right-hand side is the more comprehensive analysis that builds on the consultant's initial estimate. The bottom half of the table in green shows cumulative costs across the various stages. For example, the third row highlighted in the dotted orange box labeled stages A, B, and plus C aggregates costs and cost saving for those three stages. Staying on that row and looking at the last column, we see that the expanded scope resulted in cumulative cost savings of negative $275,000, which means that LACERA may be in the red even when all passive equity has shifted from external to internal management. The reduced cost savings were due to three factors: updated build out of costs, reduced allocation to global equities in the new strategic asset allocation, and three, improved fee terms from existing managers. Next slide, please. Although costs were a very important component of staff analysis, there were also other factors that we had to consider, such as alignment with LACERA's investment beliefs and strategic initiatives. Outlined below are the three applicable strategic pillars from the current strategic plan. This includes, for example, focusing on cost-effective efforts, but also ensuring that LACERA is appropriately compensated for risks taken. I will now hand the presentation over to Jeff, who will cover other key considerations in our summary.
Great. Next slide, please, and thank you, Ron. So we'll continue our discussions on the next three key areas for consideration, which are setup and execution, operations and human resources, and tracking error and headline risks. We will dive deeper on each area in the following slides. Next slide. For setup and execution, cost is one of the most important aspects of internal management. As Ron has mentioned, we expanded the scope of the cost study and incorporated other material expenses, such as human resources and infrastructure costs. When these costs are added, the overall savings are less attractive. Equally critical is our experience from the hybrid working environment. We need to take additional precautions, including expanding LACERA's business continuity and disaster recovery protocols, as well as ensuring continued operation and connectivity between custody, performance, and risk systems. And lastly, there's a difference in the level of complexity between managing liquid and illiquid assets internally. For instance, private assets require greater regulatory compliance, and typically public assets are internalized first and private assets are internalized once systems have been put in place. Next slide. From an operational and human resources perspective, internal management will require a concerted effort to successfully operate and will require a well thought out implementation plan. Strong internal guidelines and compliance will need to be put in place for effective oversight and monitoring to prevent actions outside of the guidelines, such as a trade error. Additionally, cybersecurity and operational risk are critical. This is one of the areas that project consultant has dedicated considerable thoughts to. there will be a need for increased IT maintenance to avoid any operational errors. Last but not least, human resources will have to adjust in order to acquire and retain talent for internal trading. Next slide. The final key consideration is tracking error and headline risks. If we do manage asset internally, we may incur higher tracking error than an external asset manager would. This is because LACERA lacks the economies of scale in terms of the middle and back office. For instance, our passive index manager has over 100 professionals to support these functions. High tracking error also means greater risk of underperforming the index. Even small deviations can impact LACERA's performance. As we illustrated on the graph, underperformance of just 1 basis point on 15.5 billion passive global equity portfolio equates to a loss of 1.5 million annually. Moreover, internal management will transfer liability risk to LACERA, which can lead to negative headline news. Next slide. Just to recap, this slide lists the benefits and concerns for internal management. Potential benefit include leveraging LACERA's asset size. The more we manage internally, the better the economics. It can also enhance investment culture and has the potential to reduce costs. On the flip side, though, the concerns are substantial. As we discussed previously, there is an increased risk for higher tracking error and potential negative headline news on LACERA. And this is even more so under the uncertainty of a hybrid work environment. There are also setup and execution concerns, as well as significant costs associated with a full build-out of the infrastructure. Next slide. Here we provided a summary of the key points from this presentation. Just to reiterate, after refining the preliminary cost estimates, we found that external investment management is economically advantageous at this point in time. Priorities have changed as a result of the pandemics. Despite the benefits we listed on the prior slide, it will require a multi-divisional effort, further development of operational and personal needs, and may introduce higher than anticipated business and financial risks. Therefore, staff is seeking the board's approval to pause the internal management project and reassess after the next asset allocation. As for next steps, staff will continue to review and enhance total fund in accordance with strategic initiatives and focus efforts that are most cost effective, such as co-investment, which have already generated cost savings for LACERA. And again, Makitas concur with our analysis and their memo is attached. This concludes our presentation and we're happy to answer any questions.
Thank you. Mr. Knox, please.
Thank you very much. I'm supportive of staff recommendation. I was just going to point out, we've talked a lot the last few months about recruitment and, where it says additional staff is necessary. I think the biggest thing there is just, recruitment, obviously, but retention. That's a huge concern, especially with the turnover that we've seen just industry-wide and at LACERA. That would be a key concern of mine with any strategy moving forward. Thank you.
No, I agree, Mr. Knox, with that comment wholeheartedly. Ms. Jones.
Thank you, Chair. Santos, I agree again with Trustee Knox's comment as well. But I do have a question on the recommendation from staff because the recommendation says to pause the project, which I agree with, and reassess it after the next strategic asset allocation session. And I was just curious as to why we picked that time to reassess it. Is there something that's connected to that that would mitigate some of the concerns that you addressed? Because some of the concerns that I see that you've brought up are legitimate concerns. And I was wondering how that would shift after the next asset allocation session. So I was just curious, what was the significance of reassessing it at that time?
Mr. Grable.
Thank you, Mr. Chair. I would say the rationale is twofold. The first is that the strategic asset allocation is periodic, so some time passes. So you figure 3 years or so. The second is the strategic asset allocation may change the amount of assets that we allocate to public markets. So this analysis that the costs are really predicated upon fixed costs and a variable potential savings, that variable savings may be greater if hypothetically the board chooses to invest 50% in public equities, for example.
Understood. Thank you.
Thank you, Ms. Jones and Mr. Grable. Personally, I appreciate the presentation. Well, before I go there, Mr. Jones.
Yeah, just a quick question, just even from an aspirational standpoint. Is there, I mean, is CalSTRS, CalPERS, is the one out? I mean, I'm trying to figure out even in this is something we should do in reading this, whether it's a pause or indefinitely pause. I'm still trying to figure out what the kind of aspirational state is. Is it worth it? And it just so happens the current conditions don't align to it. Can you kind of speak to a little bit that if we, if we're talking about best in class in this particular initiative, can you help me better understand the kind of alignment there and maybe who's doing it and what we might be able to also kind of look at and say, oh, we want to be able to have this type of system in place so that we are achieving the same, kind of efficiencies or have you as, these other organizations.
Mr. Grable.
Thank you, Mr. Chair. I will answer the question in that internal management is consistent with allocator to investor. I think that it is aspirational on our part collectively to drive more of our own outcomes. What we try to balance, and this presentation tries to balance, is that aspiration, and there's some emotion associated with that, with a more rigorous analysis. And maybe I wish the numbers were different, but the numbers are what the numbers are. And I think that there's to knowingly incur incremental costs and risks with potentially a payback period of a decade plus whenever our assets scale, I don't think is the most prudent thing. I would say, as it relates to what other plans do, is that many plans, both bigger and smaller than us, do have some aspect of internal management, in particular for public markets, but many of those decisions were made based upon old pricing methodologies, in that if you paid 5 basis points or 10 basis points to index, we pay, significantly less than that. So maybe their analysis was done when costs were different. Ours are done more based upon best available pricing. And I think that's really dramatic in terms, I think I mentioned last month that since 2018, we've reduced the cost of managing our global equity portfolio by about 40%. That fundamentally changes the math.
All right, thank you.
Great. So what I was going to say, since I don't see any other requests to speak, is that one, I really want to thank the staff for the great report. And a little, I guess I'm going to say disappointed, because I've been one of the promoters of trying to move some of the operations in-house, but I do understand the cost analysis being very key. One of the things that I didn't see here, unless I missed it, is the compensation study. I know you mentioned the issue with staffing, but one of my biggest concerns that I had from the very beginning, when I thought it would be a good idea to bring some of the operations in-house, is that we need to compete with the industry just like we're doing with every other position. But certainly by moving in operations such as the public equities in-house, it require us to hire, retain, and compete with the industry for individuals that will do that work for us. So was that looked into in terms of the compensation that we require for us to, including even incentive pay, to attract the staff to work in that endeavor?
Chair Santos, no, that was not part of the study. What we did include was the personnel as we saw the build out through the different phases that Ron had addressed that would be necessary, utilizing the current county schedule, including the full benefits.
Right. So my suggestion is that for the next time that we have this discussion, that we'll provide the board with some analysis with regards to the staff compensation that we're required to for us to be able to do this properly. That will be my request. Anyway, any other comment, question? Hearing none, I will entertain a motion for this item.
I'll move staff recommendation. This is Keith.
This is David, I'll second it.
It's been moved and second. Roll call, please.
Mr. Knox,
Aye.
Mr. Green,
Aye.
Mr. Kehoe,
Aye.
Ms. Greenwood.
Aye.
Thank you. Mr. Jones,
Aye.
Mrs. Jones.
Aye.
Thank you. And Chair Santos.
Yes.
Okay, the motion passes unanimously.
Well, thank you. Now we move into item 9, reports. Subsection A is for information only. I believe all the items are for information. Anybody has any questions regarding any of the reports? Any comments? Seeing none, we're moving forward to items for staff review.
We don't have any items for staff review.
Go to the order before we go to executive session.
Okay, Mr. Knox.
Nothing. Good morning. Take care, everybody.
Thank you. Mr. Green.
I don't have anything, but thank you to staff. Appreciate it.
Thank you. Mr. Kehoe.
Great discussion so far. I've nothing else.
Thank you, Mr. Kehoe. Ms. Greenwood.
I agree. A great discussion so far, but I've got nothing to add.
Thank you. Mr. Jones.
Yeah, likewise, thank you to the staff for the preparation and level of data. Thank you very much.
Mrs. Jones.
I do have a quick question. A great meeting today, by the way, lots of great information. But I did have a question just procedurally, as I think August, is that the month where we decided, are we still virtual in August or are we going to shift to hybrid? I was a little confused on the timeline of that.
I guess the question is for the chair. We do have, the chairs met a couple of weeks ago and we decided to have another meeting. As you know, the numbers are going up. The board of supervisors and other agencies have not moved in-house yet. So we're going to reassess that, I believe, at the end of this month. Linda, correct me if I'm wrong.
You're correct.
And we are going to have the discussion, we meaning the chair of the board of retirement, the chair of the board of investments, and the vice chairs respectively. Okay. And at that point, depending on what we come up with, we may have a recommendation for the boards, or may not. But okay. We're reassessing that as we speak.
Okay, thank you.
Thank you. Mr. Grable?
Good morning, everyone. Related to the last question, the Board of Investments offsite is going to be in September, and we're all diligently preparing for it. And if I pull up my calendar, it is September 13th and 14th in Long Beach.
With that, Mr. Grable, really quick, I mean, that's assuming that the situation with the virus remains relatively like today. But if the numbers get worse, we may have to do that virtually. Would you agree with that?
Mr. Chair, we're planning for all eventualities.
Okay, good.
We just need to be fluid.
I hear that. Every time I get a little excited about the status of the pandemic, I get shocked when I see those numbers that going up and the new variants B4 and B5. It scares me a great deal because you have the ability to get reinfected, I believe, in 2 or 3 weeks after you recover from the previous bout of this virus. So it's scary.
Thank you. Mr. Kryman?
Nothing for me. Thank you.
Thank you. Mr. Rice?
Nothing to add. Thank you.
And Chair Santos?
Thank you very much. Great meeting. Really appreciate the information provided both at the Equity Committee as well as to the meeting today. It's wonderful to know that all the work that we have done, the asset allocation, Mr. Grable, under your leadership, it has been, now we can see the fruit of the labor. And the fact that for many, many years coming out of 2009, we the board and the staff made it an emphasis to analyze the risk and whether or not we are being compensated for the level of risk that we are taking. We did everything we could to reduce a risk where we could. So I'm very happy to see where we are, and kudos to all of us here, in particular the staff who are in the front lines implementing all the policies that we set. So thank you very much for that. And at this point, let's take a 5-minute break before we go into executive session.
So the meeting will resume at 10:23.
Thank you, Linda.
Thank you.